So without any further ado, let's kick off. So Annabelle, would you like to briefly introduce yourself before we get into the detail?
Of course, Sapna, thank you very much and welcome everybody. So I work within Lloyds' capital markets team, 100% focused on sustainability. So I see the world through a green lens. I joined Lloyds in November last year, having worked in the capital markets at the beginning of my career, but then going into research institutes at Cambridge and London School of Economics. So I've come back into the marketplace, very much looking at this with a research eye and trying to help our clients navigate what is quite a complex and ever-changing sustainability landscape. So great to be here today and hope you all learn something and we can connect afterwards.
Great, thanks, Annabelle. So let's kick off. So firstly, can you help us understand where the overlap between sustainability and capital markets actually is?
Yeah, of course I can. And I'm going to flick through some slides as we go through this presentation. So hopefully you guys can anchor these in your mind. So yes, there are lots of different areas that capital markets and sustainability interact. And it's quite a new thing in the capital markets world to really see sustainability take such a forefront. What we're going to be covering today, of all the topics on the slide in particular, are the use of proceeds bonds, the sustainability linked bonds, issuer and investor analysis and insights I'm going to weave through, and then particularly the sustainable financing framework structuring, which is a key contribution that we as banking partners can make. There's also ratings advisory from an ESG perspective that comes into how companies are being seen out in the wider world, and then transition planning towards net zero. Those of you who work at large PLCs, I'm sure will be familiar with this because it's been around for a few years now. And then we've got securitizations where you see electric vehicles, for example, fixed term deposits, lots of different angles. But as I said, we're going to focus really on the sustainable bond element today. I'll start maybe with where we're going to flow. So we'll start with fundamentals. How big is it? What have we seen in the last few years? And then the sustainable finance strategy. What is it? What does it mean? What are the components? How can you, as issuers, think about this? How do investors view them, as well as how we're going to finish up? So what are the ESG assessments that we're seeing play a part in decisions from investors? So let's start with those fundamentals. We've seen a lot of growth in recent years, in part triggered by COVID and seeing a lot of focus both on social elements as well as environmental, and seeing the guidance that came out from different partners in the different players in the market, like the International Capital Markets Association, which we'll touch on later. But you've seen this growth come through. And then this year we're doing pretty well in terms of green bond issuance, and we can go a little bit more into what's happening in the sustainability linked bond market. But we're seeing, as you notice on the graph, 2021 we've seen the peak to date, and then it settled out around that 1 trillion mark. In total, $5 trillion of cumulative issuance has come to market with sustainable bonds. And I'll go a bit more into what we mean by sustainable bonds in a bit. But what this is defined as on this slide is labelled bonds. So those that have these different elements to them. Year to date, we're at $700 trillion. And I want to put this all in context. So we've got the global fixed income market at $141 trillion. This is 4.5, so that little dot that you see on the circle is proportional to the total size of the market. It is still small. In spite of this growth, there is still a lot more room to grow, number one. There's a lot more capacity for investment if we follow the trends on transition planning, on social agendas as well. But I wanted to put it in context so that you understand where it sits in the market. So these labels that I talked about, when we talk about sustainable bonds, it can be other terms for ESG labeled or just labelled, you might hear. And these are constructs that have been put on top of regular bonds that add layers of kind of criteria to the way that the proceeds are used. In the case of the top three, so green, social, sustainability, those are called use of proceeds bonds. So those are bonds which will have criteria that are green, social, sustainability attached to them and defined ahead of issuance, that the issuer then has to use the proceeds of as stipulated. So green, for example, would be clean transportation, it would be energy efficiency. Social would be affordable housing, access to essential services, those are examples. Sustainability is a mixture of the first two. So where you see sustainability bonds, those will include both green and social criteria in them. Transition is a less defined market. We've seen quite a lot of movement in it, particularly with the Japan sovereign issuance, but it's looking at the hard to abate sectors and what do they need to finance to get themselves into a place to be part of a sustainable economy. Sustainability linked is quite different from the previous one. So that is where you've got general corporate purposes. So there's no stipulation as to how you spend that money. Instead, the coupon is tethered to identified targets, so key performance indicators and sustainability performance targets. And those will go into a bit more as to how you might think about building those out. You see in the bottom right of the slide a proportion of where the market is or was in 2023. It's not dissimilar this year, with green taking up a large proportion of issuance, partly because we've got a wider acceptance of climate change and net zero and the importance to that in terms of investment structures. And so investors look for that, but also because it's got an agreed metric that is very definable. It is 1 tonne of carbon dioxide equivalent avoided here is equivalent somewhere else, so you can get that global market perspective. Social gets a little bit more nuanced. Sustainability said is a mixture, and then sustainability linked we can go into in a bit more detail. Moving on to the second part of the section, which is what do you do as an issuer to prepare yourself for one of those bonds? A sustainable finance strategy would be developed. So that is a document that ties together your finance strategy and your sustainability strategy into one place that can be interpreted by investors. So I've got on the slide an example of the Lloyd's documentation that we have developed in preparation for the bond framework. So a key to highlight that a bond issuance doesn't come just out of nowhere. It comes as a result of much work and strategic development by a company. So Lloyd's updated their sustainable bond framework in May this year. Ahead of that, for years, we've been publishing our annual report, our sustainability strategy. We have a sustainability report. We have the metrics. We have a financing framework as to how we define sustainability in our loan book. So you as issuers would also be thinking about what story you've got to tell and what funding needs you have as to what you'd put in your framework. So it would be about selecting the categories. It would be about selecting the KPIs if you're going down a sustainability linked bond route. Looking at that use of proceeds and how you'd think about that, the ICMA, so International Capital Markets Association, has the key principles that you would want to apply to the way you think about this. They are voluntary, but very much market expectations. So those of you who are investors on the call will look for that. And when you see a green bond come to market, you'll typically be looking first at the sustainable financing framework of the company, then at a second party opinion, which I'll explain. But really, this is market expectation in a way that very much addresses the investor need. So the components of this to comply with these principles are the use of proceeds. So for this here, you would see the company define, firstly, their strategy. That's a really important part I should highlight. The topco strategy, so the headquarter strategy, has to be aligned with this framework and any bond issuance. It's no longer possible to have a green bond when the company doesn't have a transition plan, where the senior management isn't consistent with that messaging. So the use of proceeds would stack up with that, and you'd see, for example, clean transportation, as I mentioned earlier on, renewable energy, obviously is a popular one, perhaps sustainable waste and water management, which is a popular one for water utilities companies, as you can imagine. Project evaluation selection is part of the governance piece, as is management of proceeds. So in those two parts, you'd be describing what committee has been set up. That's typical for evaluating what makes it into this in terms of projects that you're funding and how they comply with the use of proceeds you've stipulated, and how you're managing that in terms of proceeds. Is it in a segregated account, or is it being managed virtually? So you'd define all of that again for the investor to read, get comfortable with the approach you're taking, so that they can assess the viability of the bond, which ultimately will be about performance. But with a green bond, you're also looking for this level of integrity and impact as well. Reporting. Oh, sorry, Satna, go ahead.
Sorry, Annabelle. So those targets, we've heard about how tricky those can be. Are you able to explain a bit more about those tensions?
Yeah, so the targets, I'll come on to the next slide because that's on the sustainability linked bond, but that's a great question because that is something in my conversations with different organizations, I often get asked, how do KPIs flow into use of proceeds bonds? And the answer is they don't. So you may look at the issuer level, the topco, check their targets, and then how the capex and opex is being spent with these green bonds. But on the next slide, maybe I'll go on to that and come back to reporting because it's very similar for the two. You have the sustainability linked element. So on this one, Sapna, there are KPIs. So this is where you have the general corporate purposes that I mentioned earlier on, and you as a company will choose 1 to 3 key performance indicators that you are committing publicly to target. And the selection of those is one exercise. So you'd want to look at exactly how they are meaningful and credible for you as a company. So making sure they're core to the way that the impact you can have. And then the targets element, which is where there are tensions. Well, there's tensions on both of them, I suppose. So tensions for targets might arise because you are being not ambitious enough. So the targets are already in your business as usual trajectory. And so as an investor, you might think, well, what incremental impact is this financing having, and what story can I then tell to my asset owner? How does it inform my mandate and the end investors? So for the targets, there's the lack of ambition. Then there's some that can be too ambitious. They actually don't even seem believable because they're so stretching that it kind of feels like the number hasn't been planned accordingly. And then there is also, when you get into the bond characteristic side of it, which is where the financial element comes in. What is the incentive or disincentive for meeting those targets, and where does it happen in the life of the bond? So if you've got a 7-year bond and the observation date as to when you're meeting those targets is at the very end, you're only paying 1 year of step up coupon, and that's typically 25 basis points. Some you see at 37.5. Is that going to make a meaningful difference to the way you as a company operate? Would be a question, and that's where the tensions exist, and perhaps why we've seen a drop in sustainability linked bonds this year. So there's only been 26% less in Western Europe than there were last year. And the reporting element, just to keep moving forward, because I'm conscious of trying to get so much content in, the reporting element is similar to the use of proceeds. It is annual, it is public, and this would be for the audience of your investors. They would then take that data, extract what they need to connect into their dashboards and systems to make sure they're complying again with this mandate they will have from their asset owners. Verification is an important bit that both have as well. So for this framework, you would typically get a second party opinion. So there's lots of different providers out there. It's one of the elements we typically would help issuers as they prepare their framework and prepare for issuance, would navigate and help. With those second party opinion providers, they will check that all of this is in alignment with those ICMA principles. You might also, for the post issuance monitoring, so that annual reporting about where you are with your targets, your use of proceeds spend, you might also want limited assurance just to give that incremental comfort to investors. That is not mandatory, though it is recommended by ICMA. So yes.
Okay, great. So I guess with all of this work being done by a company, how does it land in the market, and who's actually buying these green bonds?
Not just sustainable funds, I should highlight. So quite a lot of funds want a sleeve of impact in their funds. So we've got quite a wide buying market, which is good. You'll see on the slide a few of the top names, both active and passive. They're not household names actually, but they're names that all of us will be familiar with in our world. But if you've got these names looking at the sustainable bond market, then you know you're playing for something. And here, I mean, this year to date, in Western Europe for investment grades, 29% of issuances have been labelled bonds. So by no means is it a market to ignore if you're an investor, which is why you see not just sustainable funds looking for these kind of bonds, but you also see conventional funds. What's important to note is Europe is still leading the way in terms of the percentage that they hold for sustainable assets and that demand that they drive as well. Some of you might be familiar with the regulation that exists in the EU. So the Sustainable Finance Disclosure Regulation will apply to EU domiciled funds. they have to apply Article 6, 8, 9. It's a disclosure regime. We can go into a lot more detail individually after the call if you want, but that is very much driving this demand as they see a need to disclose their activities and what objectives they are pursuing, particularly if they go into that Article 9 where you're saying that sustainability is a targeted objective. You're going to start to see them ask for more detail on the topco strategy from a sustainability perspective, on the reporting element if it's a labelled bond, and really just engage with you as companies on what that means and perhaps the rationale behind the funding. An example of some of that regulation or the voluntary categorization like ICMA is the Financial Conduct Authority in the UK has released guidance on the sustainability disclosure requirements that come into play in October, but they're being delayed a bit in terms of the mandated date until next year. We've got the anti-greenwashing rules that applies to all of us covered by the FCA, and in the EU a raft of different regulations that apply both to corporates and then to the investors as well, that are guiding the naming rules of funds as much as the actual underlying activities of the companies. So lots of different acronyms. Again, one of those things that I enjoy talking about, but I won't try and crowd into the short time we have together, but very happy to talk more about that. And with that, that takes us on to our last slide of what does make a compelling sustainable bond. So we've talked about how we've got this issuance growth, the demand for them is healthy. You've got the tools as a company to be able to communicate those messages to investors now through these frameworks. When investors interrogate this, and that's part of my job, so I work with issuers and I also work with investors, when I speak to those who are responsible for assessing these bonds as they come through and hit the screens to be able to invest, they're looking for the rationale of this bond. Is it something that stacks up with that wider strategy? Is it ambitious? Are you pointing in the same direction when you look across the organization? Because sustainability isn't viewed in isolation. Neither of these sustainable bonds, liquidity, performance still matters, and that's still an ultimate decider, but really making sure that it's pointed in the right direction. That second point, relevance, robustness and reliability. That's in leadership in particular, and making sure that the data stacks up with what leadership is saying, and being reliable with delivering on the strategy and that track record that you've got. One of the key reasons that investors still like the labelled bond, even if there's not necessarily that pricing benefit as much as there was in 2020, 2021, is the transparency and accountability they get. By developing these frameworks, by doing this annual reporting, investors are getting a lot more data that they can interrogate, they can have conversations with issuers about, and accountability to really pursuing that strategy that has been put out. You could argue that if you're doing the work anyway, why would you need the label because of the extra work to put in? This is the reason. So it's that staying accountable to it and keeping going, because that's the only way you can use these funds, for better or worse. Additionality and impact. I mean, that's an asset owner mandate that money's looking for at the moment. It's a hard one to prove, but again, this goes some way towards doing that, because in that annual reporting, you'll be talking about the tons of CO2 emissions avoided through each bond, for example. There are other metrics. And then lastly, this being able to find reporting and disclosure so that they can make the snap, not the snap, but the very quick decisions that investors have to make. So making sure it's ready, it's easy to find, it's not hidden in a corporate website, and I think that really makes it easy for them to draw that assessment. And with that, I will conclude by saying this has just been a taster. That is a complex world with many different layers to it, and really each company, each sector has different nuances about how you might build your framework, what you'd put in, what investors are looking for. So very happy to have conversations off the back of today. So hope it has piqued some interest, given a bit of knowledge, and very happy to take any questions.
Great. Thank you, Annabelle. So I think we've had a lot of information crammed into the last 20 minutes or so, and hope that has given everyone a really good overview. If you do have any questions, please feel free to put them in the Q&A. But in the meantime, Annabelle, I've got a few, if that's okay. So firstly, what happened to the sustainability linked bond market this year?
So I've teased this through a few times. So we've just seen, I think people thought that after the sustainability linked bond principles were updated, which they were in 2024, and KPIs. So ICMA have done work on key performance indicators, and by sector, what would be a material factor. we thought there'd be a little bit more appetite for that, but we haven't seen. I think in Western Europe we've seen 3 SLBs in Q3 so far. I know we're a couple of weeks off closing, but just not very many. And it's been summer. I think the challenges there still exist with what I've teased out, that credibility, the level of ambition that's going in there. Some investors, because regulation has left it vague, some investors aren't, due to their internal policies, allowed to class sustainability-linked bonds as sustainable investments because they aren't. There isn't that use of proceeds element, the spend element, so that can make things a bit trickier. And then from an issuer perspective, you're not necessarily getting that pricing benefit when you go to market. There's not as much evidence of a greenium as there used to be. So I think those are some of the factors that are contributing. But I think we'll see. We've seen a few. So NL, for example, has stuck with the SLB model. They missed some of their KPIs earlier this year on, I think, $10 billion worth of outstanding bonds. So had to pay a step up margin on that, yet they still went back to market with an SLB earlier this year. So you're seeing some still hold. That makes a lot of sense for NL who are pursuing that transition pathway and staying true to it. So we'll see how we do.
Great. And I mean, I guess you touched on NL, but are there any other particular deals that have piqued your interest this year?
Yeah, I think so. Cadence, another one that I follow closely. They are a gas network company. They went out with transition bonds a few years ago and then have moved into the green bond space with a use of proceeds. So they are spending money on the retrofit. So the transition bond was what I mentioned at the beginning as one that you buy into the journey, as opposed to what they're positioning themselves as, where they're spending money on the green element that builds into their transition story, but it's a different construct. So it's interesting seeing companies that sit within that world able to issue green and getting a really healthy appetite on it. Another quirk we've seen in the last few months is water utility companies in the UK have started, those who have updated their frameworks have started to integrate a subcategory of green, which is called blue. And you're seeing the coastal regions, so perhaps addressing an investor appetite for investing in marine life. You're seeing that come in. We've had several conversations with clients around, does that make it easier to navigate the market or harder by adding more elements of, or more colours to it, or more elements? And it is very much a subcategory of green, so it already existed before. It's just a different stipulation. There are a few funds being raised that are looking for blue assets, so marine and coastal life. So those few are the ones that I keep an eye on in particular.
Right. And I guess kind of following on from that, we've had a question. So how come the transition label has not had more uptake? This should appeal to carbon heavy industries transitioning or being part of the energy transition, and for investors to be supporting the heaviest sectors in improving their carbon footprint.
One of the reasons is that if you're buying into the transition story, you're buying, how do I describe it? You're buying carbon. So if you are an investor and you're having to report on your carbon emissions for your portfolio, if you're buying a transition story, you're buying carbon now with the promise to mitigate it, if you want the promise, but the commitment to mitigate and decrease that. But that's it requires quite a lot of complaining. I mean, it's not complaining, explaining. Complying and explaining was what I was thinking. Complying and explaining to that. So that requires a lot of communication as an issuer. Some of the investors will be happy buying into the story through a vanilla bond. I think one to look there is, as I said, so Japan went out with a net zero strategy as a country and issued transition bonds. So that's been a chunk of the volume. When it landed in the market, people, again, it needed work. It's not as simple. Green bonds are very fluid. Investors understand them. They know what to look for. They can quickly look at those frameworks, the second party opinions. But you're right in the fact that they are designed for hard to abate companies. It's just how investors view them and what they can handle today. With the regulation developing, we might be able to see some more interest in that, because you've got, for example, in the UK, an improver label coming into the fund landscape. So there, if the mandate is an improver one, then you do buy that transition story and show the improvement story. So hopefully that gives a bit of colour.
That's great. Thanks, Annabelle. So we've got no further questions, and we're close to we're close to being out of time, so we will leave it there. If you do have any other questions on this topic, please do feel free to get in touch with your relationship director or Annabelle directly. And as always, we welcome all feedback. So if you have any thoughts or suggestions for any other topics, please do let us know. You can also sign up to the mailing list on our website to receive these monthly invitations straight to your inbox. Thank you for dialing in, everyone, and see you for our next session. Thanks.
Thanks, Anna. Thanks, everybody.
Bye-bye. Bye, Annabelle.